Aloha, this is Joshua Hayes over at BigWaveTrading.com coming to you with Friday, October 17th market wrap up for you to use for Monday's October 20th. Sorry. Anyway, let's go ahead and look at what the market did today. Actually, I apologize to my subscribers in the chat room today. I was not around at all during the market hours or even after the market when I'm always around no matter what, so I can scan and look at today's action. But severe internet issues over on Maui. I guess actually just Lahaina, the island of Molokai, the island of Lanai, Princeville and Kauai, and then the east side of Oahu. Somebody cut a major cable somewhere, knocked out my TV, knocked out my internet, so I couldn't check on everything, so I apologize about that. Excuse me. Okay, hopefully that's a little bit better. So anyway, let's look at what the market did today. As you can see, the S&P 500 had some wild swings today as it evidently was up around 3% today, then came lower before rallying higher and then ending lower, down 0.62%. Volume was lower than the day before, but the sad thing is that a lot of people were expecting immediate follow-through from the follow-through day, and you did not get that, which should be a little hint that it's not all clear just yet. But still, I guess it was okay that the S&P 500 was in a tight range. But still, overall, today's price action is bearish. Why? Because it opened at 942, closed at 940, so lower than the open. And also, the intraday range, it has more intraday range above than it does below, which is a negative, because that means that there was more strength intraday that was sold off than a sell-off that was bought. So the sellers were ready to sell any uptick that they could get, and the higher the market went, then the less chance it had of succeeding, thus putting it in a very negative pattern because it closed near the lower end of the intraday range, not in the upper end. Now let's go look at the Dow Jones Industrial Average. As you can see here, BOP has gone red again, and all of this action. Normally on the indexes, I don't think it's that important. But right now, in the severity of this downtrend, maybe it is. Maybe it helps confirm all these distribution days that you see here. And then look at today's action, even more pronounced to the downside. Open at 8,975, close at 8,852. And it rallied all the way up to 9,281 on an intraday basis. But as it, again, the higher it went, the more sellers that pounded on it, thus sending it to its lows. And as you can see, it closes in the lower end of the total days range, thus giving it a very bearish pattern. Now let's go ahead and look at the NASDAQ today. And as you can see in the NASDAQ, very bearish. It opened at 1678, was able to rally all the way up to 1782 at one point intraday, and then it sold all the way off, closing at 1711.29. This is even a more bearish pattern because it's higher into the, I guess the SP 500 and Dow wasn't up 3%. They're probably up like 2%. But this looks like to me like it's a 3% range right here. So the NASDAQ was up 3% and went all the way down to actually close down 0.4% basically. So that was a pretty negative showing, and I would say the only good news is that volume is lower than the follow-through day, but still it's negative action. The lack of follow-through immediately is not a good thing to see. And then there's the VIX after hitting an all-time high of actual price data. I just learned something that I actually didn't know. The VIX didn't exist until 1992, so they only estimated what it would have been in 1987, and they estimated that it got all the way up to 172. And I think I heard somewhere that some people believe that the VIX could hit the century mark, the 100 level. So that would be kind of crazy to see. But as you can see, after yesterday's 81 reading, today the VIX still seemed to hover around the 70. And even though the market wasn't down 3, 2, or 4%, the VIX was up 4%. So that shows that there was a lot of volatility today, hence the market being up 3%, then closing down negative Negative 0.4%. Sorry. I seem to be a little confused right here. So now let me go look at the S&P 600 so I can see what those stocks did. Small cap stocks usually are the more exciting stocks that give you the bigger gains. And once again, another negative intraday pattern. Open at 282, rally all the way to 295, but you close at 278. Not good. And then the Russell 2000, oh, that's even worse. So open at 526, go all the way up to 552, and close at 526. So 0.43, lower than the open of 0.73. So it round tripped lower, and that's a negative day's action following a follow-through day. So that's not good, and it probably goes to reinforce why I didn't have any new longs yesterday and why I don't have any new longs today. And I do have a new short today. So once again, another day where I don't have any long. And remember, I'm not just picking any stock to go short because I believe it's going to go lower. And I'm not just picking not to go long stocks because I don't believe they're going to go higher. I actually have real price, volume, and BOP signals that I've taken my whole life almost since 1998. And I'd like to say that I've perfected my method in 1999, and I've used the same exact method, messing around with options every once in a while. After that, since, but I'd say in about the year 2000 till now, all I've done is go long or go short stocks. And I've used this method since 1998 of price volume BOP. So I get real signals on the downside to go short and real signals on the upside to go long. So the fact that, once again, I didn't have any new longs, along with not having any new longs yesterday, and I have a new short today, still signals to me that since the market is so far below the 50 and 200-day moving average, there is no way in Hades that the right play right now is to be long. To be long right now, when the indexes are so far below the 50 and 200-day moving average, when I've already proven, and if you guys have not done it yet, please do it, going back to at least 1990, and go long every time the market is above the 50 and 200-day moving average, and go short every time the market is below the 50 and 200-day moving average. Do that all the way to the now, and tell me what your annual gains of each year are, and then go back through your records if you're a new investor that has never held a stock for a 200, 300, 400, 500% gain, and tell me how that compares to your actual record the past 20 years. So if you would do that, you would see that by just going long the market when it's above the 50 200-day moving average and staying short or out of the market when it's below the 50 200-day moving average, you actually make a lot more money than most people do in the market. Now, if you're investing the way I invest, you're killing that kind of play. So we'll just move on from that. The only thing I want to show is I still see gold commercials on TV and hear it on radio everywhere. And once again, has anybody seen gold? I mean, is anybody actually looking at charts? Or do people not even understand how to look at charts and they think that because it's low, it's a good buy? I hate to tell you this. Look at this. Let's say that you go long whenever the gold gets above the 50 and 200-day moving average and stays above it. Looking at it the entire way, finding support at the 200-day moving average there and there as it goes all the way up to its highs in March. And as it goes up to its highs in March, you can see that gold makes like a 60% move on the upside. So that's your key to stay long this market. And then even if you stayed all the way here, you're still fine. And then right here, as it closes below the 50 and 200-day moving average, that's when you end your long. So nobody should be going long gold, because now that it's above this, with the 50-day moving average below the 200-day moving average, there is no reason at all to be long. And now that it has failed this V breakout move and broken down below the 200-day moving average and then breaking down below the 50-day moving average, gold is now no longer a buy. It isn't a short. But if you're out there thinking of buying gold, or if you have bought gold, you need to stop. You need to not buy gold. And if you are just buying gold and have bought gold within the past 8 months, then without a doubt, you need to probably sell everything you have. Because if you bought around the highs or just randomly here in May, whoops, that's not supposed to happen. Let's say you bought here randomly in May, and just now you have a 15% loss on whatever futures position contract you have. So gold is not the right play. And at the same time that people think buying gold is the smart move, when clearly I'm showing you lower highs here, here, and here, and then a breakdown of a V move below the 50 and 200-day moving average lower. Now let's go and take a look at the US dollar, which I've actually heard from people, the dollar's weak, you don't want to be buying the dollar here. Yeah, you may not want to be buying it here, but if you would have bought it back in August when it made it above the 250-day moving average, you now have a 10% on your futures position. And look at this excellent action in the dollar. Not only do you see open body candlesticks all the way up since it took over these two moving averages, but you see tails everywhere. Tail, 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 tails everywhere. So not only are there open bodies everywhere, there are tails everywhere in the United States dollar, proving that the United States dollar is still a buy anytime it can dip down to the 50-day moving average. Now, I'm going to go, let me see how much time I have here. So I know what I'm going to do. Yeah, I got to wrap it up here. Anyway, this is Joshua Hayes at BigWaveTrading.com. Have a great weekend. I'll see you Monday. Aloha.